Good morning, traders. It is the 16th of December 2015, 8:01 a.m. Chicago time. Thanks for joining. It's a Wednesday hump day. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. The key elements to pay attention to today, one big obvious one, it's FOMC announcement day. Fed is expected to raise rates for the first time since June of 2006. Aside from the decision itself, market participants will focus on the pace at which any rate hike cycle may occur. The Fed statement, dot plot, summary of economic projections will be released at 1 Central, 2 Eastern before Fed's Chair Yellen attends a news conference at 1:30 Central, 2:30 Eastern. As I mentioned yesterday, the market's pricing in a 78% chance, 78% chance of an interest rate hike. So keep your powder dry. Make sure you have credit to trade right after the announcement. I certainly would not recommend anyone with a small account to put a position on before the Fed or to speculate on the Fed decision itself. The trade is generally pretty fast, very algorithmic, pretty violent, and it's hard to control risk under those situations. So if you trade a bigger account, just cut your size and have at it and just follow your plan. But smaller accounts, stand aside. It calms down usually within 10 to 15 minutes, and then opportunities will then start showing up. UK's unemployment rate came out at 5.2% in October, slightly better than the 5.3% that was expected. Europe's flash PMIs came in mixed. Congress reached a deal last night on the budget that lifts a ban on oil exporting. This ban has been in place for 40 years. So we're changing our policy after 40 years. We saw crude oil drop on the close yesterday as news started coming out that the deal is done. And when the market reopened yesterday, we saw oil drop again. More supply to the global markets. November housing starts came in at 1.17 million versus 1.13 million, slightly better. Building permits came in much better, 1.289 million versus 1.15 million. For today, in about 10 minutes, we're getting industrial production. U.S. industrial production expected at negative 0.2%. We're getting manufacturing production at 0, capacity utilization at 77.4. All of those coming out in about 10 minutes. And then at 8:45 Central, 9:45 Eastern, just 15 minutes after the cash open, U.S. manufacturing PMI prelim coming in at 52.6 as an expectation. And then after that, we get crude oil at 9:30 Central, 10:30 Eastern. U.S. DOE gasoline inventories expected at 1.2 million. Crude oil inventories negative 500,000. Distillate inventories positive 1.5 million. And then the rate decision at 1 o'clock Central, 2 Eastern, expecting 0.25% on the lower bound and expecting 0.5% on the upper bound. There's going to be a ton of chatter about this throughout the day today until that number finally gets released. And I really hope that they raise. I don't think they would, but I really hope that they do so we can start normalizing the market a little bit. There's chatter that they may raise rates and then drop them again, which defeats the point. But in any case, other events, we're looking at a 1:30 Central, 2:30 Eastern Fed's yelling conference on the rate decision. So that's it for the news here. Let's look at our charts. So Yesterday, the primary hypothesis was not clear. If you remember yesterday, I drew chop, 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 break higher, chop, 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 break lower, and there was no clear edge because of where we were gapping. We were gapping in an old gap zone. We were gapping in between two MCHVNs. And what I left you with is the potential for a test down to 2550, but an equal potential for a test up to 204050, which is an MCHVN. I'll show you that. So let's look at the big profile. So yesterday, here we opened right here. And the idea was it could either test down to the prior days, to a recent high, and an MCLVN at 20, 25, 50 or so. The higher probability is a test of 20, 40, 50 right up here. 20, 40, 50 is the next high volume node, the next most accepted price up here. The next most accepted price below is down below in the 2019 area now. And if on any drop, that would be the key target below. Notice I'm looking at not only price action, I'm looking at price action levels, meaning prior highs, prior lows, all that stuff. But I'm also paying particular attention to the auction itself, to the volume profile, because that price action creates the volume profile, with the volume profile giving us an added layer of information of telling us how much, not just that the market went to a certain area or traded a certain price, but they're telling us how much it traded in that area or at that price. And that's why this is my preferred method of looking at the market. It works great when the market is within itself. You have to abandon it when the market makes new all-time highs, new all-time lows, and so on. It can't make new all-time lows, but recent lows, because then it moves away from the auction. We have brand new virgin territory, and in that situation, I start looking at price action alone, rotations, extensions, things like that. So basically what we did yesterday is we did test up, and you can see that it went right up to the LVN, the next MC LVN right here. It went right up against it at 45.75 before it turned around and went the other way. It's kind of interesting that we battled yesterday a lot on the way down, and we were unable to get the delta to be negative. So a lot of buying interest yesterday. The delta just continued to be positive. Again, rollovers affecting that. We're not, we can't rely on delta as much as we'd like to. We can't rely on volume as much as we'd like to because of the rollover effect. But there was just a pretty big rotations down. And a beautiful pullback to the mid, a nice virgin pullback, first touch test of the mid, beautiful trade here, and a rotation down puts in a lower low, and then it screams up back to the mid on the close. The NASDAQ, by contrast, broke below, pulled back shallow, and actually went neutral on the day, breaking the IB low as well as the IB high. That's the NASDAQ. The ES and YM could not do it. The ES could not even retest its open on the close, despite all the work that was done here by sellers. There were buyers that came in on the close, some really strong volume that came in even after the cash close. So there was a lot of buying interest. The idea here is that there's positioning going on that is likely to push us through and to the upside. Again, there was a fair amount of accumulation, in my opinion, yesterday, and it's resulted, as you can already see, in the break higher. We're trading up here this morning at 2047.75 with the overnight high at 2050.50. The market has found its buyers. If you go back to Monday, I came in with just a big fat warning that we are likely to flash up. We're likely to push up strong, and I caution shorts or folks with short positions to put on their hedges or lighten up. We're likely to push up. So we've had a gap, and the key element yesterday that we have to take away is that we created a gap zone below. We opened in a gap, and we just completely failed to retest this gap. So this gap gets marked on the chart. The gap is from the 1575 up to 2950. And it's something that we have to watch out for. This area becomes something to watch out for because it is an unauctioned area in the most recent rotation or the most recent auction. It's an area that's undiscovered yet, and so this becomes an area of weakness. So as the market breaks lower below yesterday, the expectation is for it to drop down to the 2250, which is the midpoint, chop around, retry higher, and then likely to push through at some point and fulfill its destiny of its likely destiny, I should say, of retesting the interest by buyers and sellers in this gap area. So we did leave a gap, and that's one of your key elements yesterday, is that the IB was put in and it did not make any attempt at filling the gap or pushing into the gap zone. That's quite bullish. I did warn early on because of the opening type. I warned early on, if you're on Twitter, if you're following on Twitter, I warned early on that to be cautious because there's initiative buying on the open, which means that it is a higher probability, not a high probability, but a higher probability of a trend day or a buying day, and the caution was put out to shorts trying to fade it. When we open and we have this much delta coming in, this much aggressiveness coming into the open, and the market has this big rotation up, 8.25 points yesterday for the opening swing. That's quite a bit for this product. That's a very wide opening swing, and generally you do not want to fade those or sit on the opposing movement for too long. You want those trades contrary to the opening type to be scalps or short-term trades. Okay, so that's how things shaped up yesterday. Overall, the auction was very orderly. I believe that based on the action that we saw yesterday, I believe intermediate OTF traders, participants were present, and the auction was very thorough and very clean. This is why we form this nice belly here before we broke up and again down. But when you have a nice belly like this is an orderly market. It's an unemotional market, most likely. It's when you have a profile that kind of looks like a jagged thing. That's when you have emotional trading, and participants are basically trading in a panic or euphoria. Yesterday, it was very deliberate and very, very evenly distributed. So it looks like our numbers just came out. Industrial production came in at negative 0.6 versus negative 0.2. Cap utilization came in at 77.4, better than expected. Industrial production is lower, cap utilization slightly better. Let me check that. Cap utilization. Yep. No, actually, it's slightly worse. 77 versus 77.4. Okay, so let's look at the overnight session. Finish up here. I'm kind of getting sidetracked. The overnight session shows that not much occurred on the reopen. We started rallying on the Asian session, and then we continued to rally strong on the European session. The profile showing advantage to buyers. Lots to battle here. A weak high. The expectation is for this 2050 to be taken out. The market is definitely finding its buyers at the moment. Today, being FOMC day, being such a key day, we're likely to open and see some pretty aggressive moves on the open as folks use futures as a hedge and square up their positions today. Risk managers on high alert, and therefore a lot of we're going into expiration as well, so a lot of managers are likely to make sure that their positions are somewhat hedged. So we're likely to see higher time frame participation early on. Then we expect it to just absolutely die out, probably 10:30 central, and then we'll be in anticipation of the 1 o'clock central release, and then volatility is likely to shoot through the roof once that happens. This morning, we're opening out of range. The expectation is that we are likely to take out the overnight high, to take out the week high that we have there, and then I expect it to be responsive and retest the MC LVN at 44.50 down to 44, and potentially push into the profile. The value the value high is valid here. The next area below 44.50 to test would be 40.75. Once it breaches 40.75, it's likely to pull back and get down into this the 35, this point of control at 35 and a quarter. That's my primary hypo. We do have a weak structure. As you can see, the gap zone has been marked down here. We do have a weak structure below. I believe that based on prior action, I believe the market's likely to be more responsive than initiative. In other words, the market is likely to push up, then respond, rather than be responsive and then get initiative as its key move. So that's my primary hypo. I'll leave you with that. I think I'm over my time. Enjoy your day. Save your bullets. Good luck today. Take care.